Stock market, S&P 500. We're going to look at interest rates first, and there may be a surprise ahead. You're going to get an idea of the cycle analysis, and then we'll look at the S&P 500, intermediate and short-term analysis, and I think you're going to find this absolutely illuminating. Let's take a look here at TNX. This is a weekly cycle chart of TNX. Those of you that are brand new, these arches that you see on the bottom are half moons. These are called cycle brackets. This is how we see the repeating rhythms in the market. Cycles move from trough to trough, and there are repeating time frames. You can see the energies as money moves in and money moves out. It's the way that we see money flow. You can see that in there, and we get more and more information as these formations occur. You can see when you get a bullish cycle like this, the odds are very high. You're going to get another bullish cycle just like this. When it fails and isn't after some significant time frame able to make the high, you usually end up coming and taking out the low. So you see that you get corrections in these phases, rising phases, peaking phases, declining phases, and bottoming phases. That's how we see these. We also use the reversal scout on here for momentum, and we use a reversal scout or the slim ribbon for momentum, slim ribbon PO. Those are all our indicators, and we also look at here at a 13 and 34 week moving averages. We don't look at the 50 and 200 or 100 like other analysts do. We have our own way of looking at this. When the reversal scout is positive, turns positive near a bottom, near that trough, it tells us it's likely to keep rallying until it tells us that it's in a corrective mode. And we get that information. You could see what happened here. And this was we labeled this that it was very likely a cycle peak when that was made in there. And now you can see that interest rates look like they're going to come down into December, into January. These two blue lines show you that it's about the third week of December to the third to fourth week of January is the range of time that this trough is likely to come in. It tells us that interest rates are likely to fall. Those of you that watch me on a regular basis, or RV, we talked about that it was likely we're going to test 440 yields. And you can see we've done that, got under 440 yields. And actually, this looks like into this December-January period, it could get as low as 424. 4.24 yield. That means that there would be a rally in the 10-year or rally in the treasuries to get the yield down. So that, based on the way the stock market is acting, the stock market likes the lower yields right now. The lower yields, when they move down sharply because the stock market moves down sharply, that's a different case. But in this case, the higher yields were choking the markets, and it was giving an indication that the huge demand from the government was going to keep yields high. And now with this momentum turning over in this period of the next 4 to 6 weeks, excuse me, looking like yields can stay soft, that says to us that we'll probably have a period in the stock market where the stock market can pretty much remain on the firm side. Now, when you see this period right over here, and this is the key thing we're looking at right now, is that out over here in late January, February, and March, it looks like we're going to be in a new rising phase. So if yields are going to be going up here, it must mean that the Fed is going to maybe at that time be saying, well, it's not really time to be cutting rates yet, or maybe inflation numbers will be ticking up again. Something is likely to happen out over here to scare interest rates back up for one more blip. And the analysis on the 10 years or on the treasury says that they're likely to fall and test recent lows into this period out here into March or April. That says that yields are likely to be rising again, and that isn't necessarily very good for the stock market based on how they're trading right now. Present correlation. So we're looking at 10-year yields right over there, and even though this is likely a cycle peak in the yields, it is very probable that it's going to get tested out over here, and that we could see 5-year yields again on the 10-year out here in this March-April period. Not many people are saying that, but I think this could be a surprise that actually gets the stock market into a correction. Now let's switch over to the S&P 500 and take a look at that timing. So in here you could see the cycle action that we're looking at, and the market we believed would be in correction, and you could see where the momentum turned over here in this yellow zone. This was the period of risk that you could see that we had labeled right in there, and the expected softness starting in August and down through October. We had that pretty much nailed. We thought it could get to 4,100. That we thought 4,200 could hold it over here. 4,100 was a pretty good shot, and we saw it fell about 10.9%. And we thought that the daily chart would give us a low in late October, and that's exactly what happened. You can see the cycle rhythms that are in here. This is a harmonic family, and you can see the half cycles that are in there, and the half cycle right in here. And that next half cycle comes down over here into this January period, and then out over here into that period of April and May, March, April, May, where I showed you that yields are likely to go up. You get into that next period of risk over here. So what does that tell me about the stock market? Let's get a little closer look in here so that you can see how these line up. Right over here in this period, this is a tough spot. Now, we had a repair level right there. We thought if it got through 4,500, it could get to 4,607. Back to that peak, back to these key resistance areas. There's a fib extension right in there and that cycle peak resistance. It could still get up over here to 4,607. I have no problem with that possibility. Also, there's a key number out over here at 4740-ish. That is a possibility. Probably more likely, if it would happen here before this decline that begins sometime in February or March that comes down into this April period. So there's a possibility that this would be a stronger move out over here to that level right there before it turned down. Or there's a possibility that that 4607 level, I'm just going to duplicate that, comes out over here, out into the summertime, spring and summer into next year. So we're kind of looking, and I said that this analysis was going to be intermediate out for a few months. There is a possibility we get over 4,700, but the possibility of getting back to that 48 and change to all-time highs, I think, is extremely low. So I think ultimately what we're going to be in is a pretty wide choppy period. This correction right in here that we're looking at, and I'm going to get closer again for you to see right like this, points to it getting down to potentially the 23.6%, which is right around 44.60. That's not much of a corrective period in here. More likely this period out into January, so peak somewhere out over here in December, come down into January to about 43.90, and then begin to move up again. This becomes a buy zone right over here, but this says that we're likely to be in a choppy period in here. We'll call it 4607 down to about this area of 43.90-ish, 43.95 over coming months. This could be all the way out here into this March period before it gets into this bigger period of risk, with an outside chance of one of these rallies taking you up to 47.50. I have doubts about this, especially when we have NVIDIA come out with fantastic blowout earnings and the stock go down. I mean, it really says that the tech stocks have priced in the move, and that it's more likely that we're going to see the retails, which the numbers really look like they're projecting to be really bad, out for the Christmas season and moving forward. Those kind of stocks weighing on the market, and the tech stocks giving ground in here because they are way, way priced. There's so much baked in the cake in them. In that Magnificent Seven, that it's likely we're going to get into corrections. I'm not showing you the NASDAQ today. Remember, you can get our full analysis on the S&P 500, NASDAQ, and the Russell, all of those indexes, by becoming a level 3 or 4 member. And level 4, of course, gets them live on the Thinkorswim platform just by downloading our charts. So again, we're looking at a range in here. 4706 is pretty likely. Coming down and correcting into this area under 4400 is pretty likely. 4390-ish or something like that over this next couple of month period, and then maybe widening out the range out over here. And then the next bear market we'll start talking about sometime after that period, the next cyclical bear market, because I already think we're in a secular bear market right now. You can watch our big picture analysis at the beginning of the year or in the middle of the year to see my big picture analysis showing the secular bear markets, or you can wait till the beginning of the year when I publish that for the public sometime out in January. Our members will get that probably around the end of December or the first week of January. So this is the intermediate look right over here. Where we're expecting range trading to begin fairly soon, maybe a little more on the upside that we have in here, 1.5%. That may be the best of it that we see here in the near term. Take a look now as we look at the daily charts, and again, you'll see the magnificent cycle analysis that's in here. Take a look at these rhythms in the market. You could see the harmonics on the bottom, and then just look at, let me just get my pointer. I don't have my big red pointer today. You can see the rhythm in here, the half cycle, the half cycle, half cycle, half cycle. And look at that. Each of these minor cycles give you the declines right in there. And when they're joined by the bigger dominant ones, they are bigger declines. So where are we right now? Well, we're in a period like this right here, where you're likely to get a minor pullback on that powerful upside move. That's somewhere right in here, and then moving up to the upside again. So this is the short-term view that we're looking at right now. And what we see in here is that we have a powerful cycle in here. You could see the slim ribbon right here where it turned positive, the slim ribbon PO turning green. It's so powerful, it can't even get to an area where it gives you the upside arrow signal because there's no selling in here whatsoever. We're looking for minor selling in here. That 23.6% at about 44.50. That is a reasonable pullback over the next week or week and a half. The trough period is December 1st to December 11th. So somewhere in there, we're looking for a pullback and a bottom and then moving up again. Again, this is that 4607 area that it's pointing to on the daily chart. And you can see that signal, that warning right there. It says that if you got through that red line, the 76% repair level, it warns of the test of the 4606 peak, and that's this level right over here. It's also a major fib extension. So 4606, 4607, so it depends on which one's lining up. That's where we're projecting, either now or a pullback and then getting up there over here. No real risk that we see in the market right now. Momentum conditions powerful when you look at the slim ribbon right in here. When you look at the reversal scout here on the weekly, powerfully moving up, only 4 weeks into this advance off of this trough. What you get is only minor corrections under those conditions. And therefore, the cyclical bull market we're in has life. And pullbacks, if we get them here as expected into January, are going to be buying opportunities for more on the upside. That is my extended look comparing interest rates, which we see the surprise ahead, where we think we're going to see an upside bump in interest rates, maybe testing 5% again in Q1, and then bringing that correction we're looking for in Q1, potentially down into April, and that could be a pretty sharp correction in the stock market during that period.